Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Normally I do subscriber requests on Tuesdays, and I did one yesterday on Intel. And in the comment section of that video, I was literally inundated by requests to cover Lockheed Martin, which kind of incidentally or coincidentally, because I am long the stock, I was going to present and cover in a video forthcoming anyway. So I kind of rushed it up a little bit. So today I'm going to take a look at Lockheed Martin. It was in the news yesterday on a mixed earnings report. And something I want to say before I get into the video itself and start showing the company via the FastGraphs Fundamentals Analyzer software tool, I want you to focus on the difference between what I would call a market overreaction and what the headlines presume. If you looked at the headlines, the stock was down approximately 10%, and that, is always a number that tends to get people's attention and get them all excited and all even concerned or worried. I'm going to try to illustrate here from my perspective, nothing really has changed a whole lot on the long-term story of Lockheed Martin. A little bit has changed on the short to intermediate term, and I'll try to cover that more fully. But I also want you to note that the reaction to the stock price was probably an overreaction to the long-term scheme of things, and I'll try to illustrate those things. So let's get into the FastGraphs Fundamentals Analyzer software tool and look at Lockheed Martin. So I'm going to start by taking the price off the graph here, because what I want you to see is the business behind the stock first. I always like to do it. I like to look at the company. This is the operating earnings of Lockheed Martin multiplied by a PE ratio of 15. This is giving you a very clear picture of the history of this business. It's had 14.64% growth going back to 2001, but it's also been a little bit lumpy or a little bit erratic, if you will. You can see at the bottom here, that includes some really high numbers coming out of the recession of 2001, where, they had a 37% earnings growth followed by a 76% earnings growth. But then they had a -1, an 11, a 35, a 39, a 28. So this was really a golden, some golden years. Now, if I use the scroll bar here, just so you're clear on that, and go back to that time, this was a time when Lockheed Martin's earnings were growing at 30% a year. So here I'm using the P equals growth rate as a valuation reference, and I put the price on there. Based on that growth rate, the stock was really undervalued, relatively speaking. The normal PE over this time frame was in the 20s, all right? But now watch what happens as I expand this graph out. As you expand the graph out, the earnings growth rate drops down to 14.64%, or roughly half of what it was in those, golden years there between the last two recessions we had. But that's, pretty typical. Now, I want to lock this down a little more. I want to drop this down to the last 14 or 15 years. Let me actually add, maybe make it 16 years, because I want to show coming out of the Great Recession up into the COVID recession. And now we see earnings growth has been about 8.36%. But the devil's in the details. And again, I'm back to using a PE ratio of 15 as the fair value, intrinsic value valuation reference. But interestingly enough, over this time frame, the normal or market value PE has also averaged about 14.61, or you can see the blue line and the orange line are almost connected here. But it's always how, those numbers are calculated. You can look coming out of the Great Recession. This was very typical of aerospace and defense companies. We had single-digit PE ratios and as low as 10 multiples for 4 or 5 years here. Then we started to see, and we had growth rates of -1%, 2%, -1%, 6%. Then we saw a period of accelerated growth here, and the stock price reacted to that. And then from 2014, we had this period where, we had very high multiples on the stock for about a 4 or 5 year period. I really want to showcase that, though, because this happens quite often in the market, and I would refer to this as irrational exuberance. But then we inevitably get a reversion to the fair value or intrinsic value line, and then we had overvaluation again, and then a reversion to the fair valuation line. So bottom line is, price kind of goes where earnings go, number one, but price also reacts to what the cash flows, or in this case, I'm looking at adjusted operating earnings of the business, will generate. Now, the company just reported earnings on October 26th, yesterday, okay? And interestingly enough, the company beat by 13 cents, non-GAAP earnings by 13 cents, and they beat GAAP earnings by 22 cents. Now, GAAP earnings, which are also available in FastGraphs, would be under the diluted earnings. So they beat on both of these metrics for this last earnings report, GAAP earnings as well as operating or reported earnings. What happened was, though, the company did miss on revenues. Now, I want to drop this a little bit more here because I want to focus on recent revenue growth here. This is recent sales. Now, currently, Lockheed Martin is trading at 1.37 times sales. Their normal price to sales ratio is about 1.67. But what I really want you to see is this is the big drop that created all the hoorah and the reason for all the demand, of everybody. And I missed it there. I didn't get the top there, but you can see it's about a 10% drop. That's what it looks like when you look at that in relation to all the other volatility that this stock has gone through. The price has gone through over these years. It's not that big a deal, but it was a 10% drop. But that's what it looks like graphically, which isn't anywhere near as threatening. Now, the problem was the revenue came in 2.8% short. They missed it by $1.09 billion. The revenue came in at $16 billion, and they were expecting, over $17 billion. All right, so the bottom line is that the revenue's disappointed. Now, the company also made some pretty stark announcements. There was actually an article in Barron's magazine that was really kind of a scathing article, and I think it's part of what created a lot of the interest in the stock, and it pointed out that Lockheed Martin sales disappointed and it will get worse. The stock is tumbling. Okay, at this point, they talked about it being down 9% in early trading in respect to the S&P and the Dow both being slightly up. Okay, now what happened is it reported third quarter sales of $16 billion, down from $16.5 billion in the same period in 2020 and below the $17.1 billion that I referenced earlier that was expected by Wall Street, according to FactSet, which is where we get our data for FastGraphs, by the way. The group also slashed its full year sales outlook to $67 billion, down from $67.3 billion to $68.7 billion, which is what their previous guidance had suggested. Now, I want to make a very strong point here. This isn't good news, and I don't want to try to imply that I'm trying to spin it as good news, but it's not Armageddon. It's not the end of the world. This is still a very good revenue picture for the company, as you can see here. Now, the revenue growth is expected to be weak for the next couple of years, and we're showing that currently on FastGraphs here as far as, sales and revenues growth. So if I go to the forecasting calculator here, they are followed by quite a few analysts, 15 to 17 analysts, and we're expecting rather anemic revenue growth over the next couple of years, okay, which the company announced and the company guided to, all right? And that's what created all the problems here, all right? And that's what, the Barron's magazine was, so awful about. But the point I want to make is the company is not bleeding red ink, and it's certainly not going out of business. And expectations are still, from an earnings perspective, still pretty high for next year, but then following the following 2 years as a slowdown. So that's what we're currently looking at with forecast. Now let's look at forecast data a little bit here. And one thing it's kind of a pet peeve of mine. I get people always complaining there's a lot more to it than looking at analyst forecasts. Let me tell all of you geniuses something. If you're going to invest in a stock, you have to have some expectation of what your future return should be or will be. To me, it's the very first step in investing. At FastGraphs, we get consensus of leading analysts, professional analysts who are paid to follow the company and follow the industry, and we get their view. And their view is also, by the way, tempered and guided by company guidance, the company also trying to talk. Now, does that mean these numbers are perfect? Well, all we got to do is go to the analyst scorecard on Lockheed Martin, and what we find out here is whether the analysts are making a 1-year forward estimate, which we, by the way, give them a 10% margin of error, or a 2-year forward estimate. This company has met estimates, and they did it again this last quarter, by the way. This is earnings estimates we're talking about, or exceeded them, 33% of the time on the 1 year. They met them 67% of the time. And they met analyst estimates 92% of the time with a 2-year forward estimate and beat it 8% of the time. So all that tells me is this company has a very good record, or the analysts have a very good record of getting the estimates right. Doesn't mean they're going to be right, and they're also dynamic. And this is important because, for example, 6 months ago, the analysts were expecting 2666 for this fiscal year. 3 months ago, they were expecting 2690. The most previous estimate was $22.23, and it's now been adjusted to $23.36 expected for this year end. And the company has pretty much guided that. That's a minus 8.75% negative result prior to last year. And again, this is operating earnings. Now, from a standpoint of going forward, they're expecting a very strong year next year, but then followed by some flat years. But assuming this stock trades at that, right now I'm using the Graham-Dodd formula because it's under 5% growth over this period of time. That still calculates out to a fair value of about 14.96. We'll call it a 15 PE ratio, which would imply very good rates of return if the company, if and when the company earns this amount of money that's expected, and if it trades at those valuations. That's all that data is saying, but I do want to point out that the estimates are dynamic and they can change, and they might change even very soon, which is something that I'm going to be watching because I am long the stock and I do like this company very much. I had purchased it when it was undervalued back in here. It got, fairly valued again recently. It kind of got a little bit, and by my strict adherence to valuation, overvalued a little while ago, but now this recent announcement just brought it back into alignment. There's not a great margin of safety, but this stock is certainly reasonably valued. Now, management did try to counter some of the negativity by talking about cash flows. And this is something that's very, very important because their operating cash flows have been very strong. This company generates good operating cash flows. Every now and then, operating cash flows have dipped, but they've generated good operating cash flow coverage, and they're still expected to generate good coverage going forward. All right. So in spite of the fact that they do expect cash flows to level out, the company is committed, and they announced it in their earnings report, that they will be generating good cash flows. And I'll show you a little more on that here in a moment. So cash flows look good. Now, this is a dividend-paying stock, currently offers a 2.85% current dividend yield, and it's trading at a blended price to cash flow of 10.57, which gives them an operating cash flow yield of over 9%, 9.46%. I consider that very attractive and very reasonable and very rational, relative to where the price is valued today and what the company is capable of generating. Now, the real test here is management has committed, and they tried to soften the blow of missing revenues by pointing out two things that I think are important. They expected their cash flow to remain strong, all right? And this is, operating cash flow historically. We don't have a December number yet, obviously, but this was their dividend per share. And I do want you to notice that their dividend has grown. This is the dividends per share, and the dividend has grown at about 18% a year historically. If I shorten this to the last decade, it's grown about 10%. So the company has announced in their earnings report that they're still committed to paying this dividend. And this is the reason I've invested in this stock. I do believe it's cheap enough now to give us a nice potential capital appreciation, although I do expect there to be some, concerns over the next couple of years again before this company starts growing again, which management has already guided. I want to make that clear. So if I go back to forecasting earnings, we're looking at relatively weak earnings growth. The long-term earnings growth trend is expected to be about 5.5%. And once again, that gives me a capability of a double-digit rate of return, but it gives me a very nice dividend yield that I expect to continue to increase and to grow. So the dividend growth trend is something that I'm, very, very interested in as an investor in Lockheed Martin right now. So let's go ahead and let's go into the in millions graph, and let's look at a couple of items that I also like to look at. I like to look at net operating cash flow or cash flow from operations. And what I want to see is I like to see net operating cash flow. I want it to be higher than net income. Okay. So they passed this test for me. The orange line here is their net operating cash flow. The green line is their net income. So they're generating excess cash. I think they're going to continue to do that. The company has guided that they're going to continue to do that. When I look at it from the standpoint, I'm going to go to the per share graph here now. I want to move to that. And what I want to look at is I want to look at dividends and dividend per share growth. And I'm looking for a trend. You can see they've got a very excellent trend of dividend growth, over history per share. And I like that. That's what I'm looking for here. Growth yield, a company that's going to continue to grow their dividends. Now, I like to look at some other profitability ratios here as well. All right. So I want to look at return on equity. The company does generate very high returns on equity, and part of it has to do with the company's equity is actually very low, but they generate 150% returns on equity. But I also like to look at returns on assets. Okay, their returns on assets, I like to see returns on assets at least of 10% or better, or at least better than industry average. And the company has, 12 and 13 and 14% returns on assets. So all in all, I think Lockheed Martin is an excellent company. Now, if you go into their most recent earnings report, and I'm going to kind of end the video with that, many of the things that I covered here, they talked about. They talked about their $16 billion in revenues. They generated $1.9 billion in cash from operations. They returned $1.2 billion of cash to stockholders. They did break it down by segments and segment operating profit, and that's something that I think you need to look at. They did have a $4.72 non-cash pension settlement charge that affected diluted earnings, but their cash flows were good. They threw off, they generated we'll call it $2.2 billion in dividends, and they returned, free cash flow was high because their free cash flows were impacted a little bit. Their sales was still good. Their current outlook is for $67 billion in sales. They were originally guiding to $67.3 to $67.8. The segment sales outlooks are very interesting here. If you look at prior versus current, their aeronautics did 27.2 to 27.6. It's going to average about 26.750 for the current. They were expecting 11.9, or they did 11.9 to 12. Now they're at 11.850, just slightly below their beginning point. Their missiles and fire control segment was expected to do 11.6 billion to 11.9 billion. They're going to come in right at the low end of that. But again, the bottom line is they claim that supply chain is impacting aeronautics, missile fire and control, and space. So those are things that are relatively temporarily, in my opinion. And then their profit outlook is also been impacted. And I'm going to let you guys go through this yourself, where you can look at, go through their presentation here. This is something you should always do when you look at these companies. Anyway, the bottom line is when I evaluate this company right now, I think it's become very attractively valued. I think it was reasonably valued prior to this announcement. I don't see Armageddon here. I think there's some, issues that the company's dealing with. They've kind of reevaluated their 5-year plan. I believe this company has a great long-term track record and a great future ahead of it. And it's got, almost a 3% dividend yield now. If you wanted to start taking a position, now would be a good time. If you wanted to wait a little bit to try to build in a little margin of safety, that might be, possible. But of course, you're taking a chance that the stock is going to turn around. It's already recovering just very slightly today from the debacle it went through yesterday. Anyway, that's this Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. This was my take on Lockheed Martin. I think that, the reaction to the reaction was overdone. In other words, a 10% drop in stock price was probably reasonable given the news that came out there, but it wasn't Armageddon. I don't see this company being in any stress or trouble. It's a very high quality company. It's A- rated, has 62% debt to capital. It's got a good, strong balance sheet, generates good cash flows. So it should do fine going forward. If you like the video, give me a like, ring the bell, subscribe to the channel if you don't already. And you might also want to take a look at the FastGraphs Fundamentals Analyzer software tool. I personally wouldn't even think about investing in a stock without it. Thanks for watching.